Imagine you own this 12-unit apartment building and on paper it's worth $1.2 million. And with a single decision, you can make it worth $1.5 million. Or if you are careless, you can watch it drop to $1 million. The difference? Net operating income, also known as the NOI, the single number that will determine your property's cash flow and value, both present and future. So in this video, I'm going to share with you why every successful investor lives and dies by the NOI. I'm going to share with you how to calculate it and then how to use it to skyrocket your profits. And by the way, what I'm teaching here does not apply to single family rentals. This will demonstrate the power, the unique power only found in commercial real estate. Or you can avoid getting left behind. If you have any questions at any point in this training, feel free to text Peter to 833-942-4516 and I'll get back at you. All right, you ready? I'm ready. Let's get started. I'm going to start off today with why your NOI is the lifeblood of your multifamily investment. You see, in multifamily investing that's 5 units and greater, the NOI isn't just a number. It is the actual lifeline of your multifamily investment. You see, in single family homes, let's say you have a 3-bedroom home, that home is determined by what other homes in the neighborhood have sold for. In multifamily investing, it doesn't work that way. Your multifamily investment is only worth what your NOI says it is, okay? So the NOI determines your multifamily value. Let me break it down for you. So your NOI will determine your property value, your current property value. It will help you determine the cash flow after expenses, and I'll give you a calculation in a minute, but also equally important, maybe more important, it will also help you determine what the property's future value and future profits will be, okay? It is so important that banks will lend based upon the NOI that the property has. So the higher the NOI, the more apt the lender is to give you a loan, okay? And then appraisers will value the property based upon the NOI as well, okay? For multifamily, 5 units and greater. And you, the investor, will make the best decisions based upon the property's NOI, okay? This is why the NOI is your lifeline. Got it? All right, so let's go on next to how to calculate it. Got questions? Simply text the word Peter to 833-942-4516 and we'll help you. Next, I'm going to share with you what the NOI is, how to calculate it, okay? And it's a very simple formula. I am going to use a 12-unit apartment building as the example. Here is the formula, okay? The formula for the NOI, how to calculate it, is very simple. Gross rental income minus your operating expenses. That's it, okay? Here's an example. Again, I'm going to use a 12-unit apartment building as an example. Let's first of all calculate what the gross rental income is. Here it is right here. So the gross rents are, let's say I'm charging $1,200 for each of my unit, my 12 units. So I have $1,200 per unit times 12 units, okay? Times 12 months, okay? Because I want to know what my gross rental income rents are for the year. So it comes out to be $172,800. Next, okay, I'll put that right here. Next, what I have to do is I have to subtract the vacancy, okay? And the reason why is if you don't subtract any level of vacancy, what you're saying is that you anticipate being 100% full for the entire 12 months. That's not going to happen. Some person, one or two, is going to move out and person move back in. So you're going to have a little bit of disruption, occupancy disruption. That's called vacancy. So I put it at 5%. Kind of an industry standard. Okay, so 5% of 172,800 is 8,640. So I'm going to subtract that number, this number from that number, okay, to get my, what I call my effective gross income. Okay, next what I'm going to do is most likely, there's maybe a small 4 or 5 machines in my building or for laundry. Okay, and that's going to bring in $3,600 for the year. Can't call it laundry. Okay, so I have my gross rents minus my vacancy. I'm going to add back in some laundry, and then I'm going to subtract my operating expenses. Operating expenses here are $60,000. Okay, so 172,000 minus vacancy. I'm going to add my laundry back in, and then I'm going to subtract my operating expenses of $60,000. And those operating expenses are taxes, insurance, repairs, maintenance, management, things like that, normal operating expenses. So we do the math, the net operating income is 107,760. Okay, that is the NOI. That's how you calculate it. It's very simple. Gross rental income minus operating expenses. Got it? All right, let's go on to the next part where I get to break this down even further for you and show you how to use it. Every successful commercial real estate investor has a mentor. Get mentored by me and my team by applying to be our next protege. Click the top corner. As I continue, I want to make sure that you're calculating the NOI correctly. Okay, this is something that seminars or books don't include when calculating the NOI. Okay, here's a rule of thumb that I want you to really listen to. Okay, the NOI calculation should not include the three following things. Okay, if you see them, remove them. It should, when you do your calculation of NOI, do not include any mortgage expense. Okay, so the mortgage expense is not an operating expense. Your NOI only includes operating expenses, taxes, insurance, maintenance, property management, right? Accounting, not mortgage. Okay, if the mortgage is there, remove it. Okay. Number two, your NOI should not include any depreciation expense. You will sometimes see that in the owner's report. It'll be there as an expense. It's basically a tax write-off. It's a pretty sizable number too, right? That is not an operating expense. It's a depreciation expense. This is a finance expense. This is a depreciation expense. Does not to be included. And lastly, do not include any capital expenditures. Okay, what is that? Capital expenditures are roof replacements. Capital expenditures are also parking lot repavement. So big ticket items like that should not be included because operating expenses are your recurring expenses, repairs, maintenance, tax, insurance, things that recur time and time and again that you do every month. You're not going to do a roof every month. You're not going to do a parking lot every month. So capital expenditures should not be included. No depreciation, no mortgage expense. And hear me out here. If you see any of these items shown on the seller's income expense statements, I need you to delete them or to remove them in your calculation. Got it? All right, so we'll leave that with you. All right, next, let's go on to the beauty of the NOI. Let's do that next. All right, here is the fun stuff, right? I'm going to share with you now how NOI drives property value, how NOI, as it goes up, not only increases the property value, but also can boost your cash flow like no other. Okay, let's get started. So what I'm going to do, how NOI drives property value, I'm going to use a 12 unit apartment example, the one I used 5 minutes ago or just a few minutes ago. And then we're going to assume that we are in a 6% market cap rate area. Okay. And if you recall my last example, right, my 12-unit example, the NOI was 107,760 per year. Remember that? Okay. So store that in your brain. Okay. All right. So I'm going to start off with the valuation formula. So this is how you value a property based upon the NOI. Okay. So here's the formula. The value of the property equals the NOI divided by the market cap rate. Okay, I have the NOI, if you recall, 107,760, market cap rate of 6% right here. You do the math here, so the current property value is 1,796,000. Okay, so this is how banks calculate the value of your property. This is how appraisers calculate the value of the property, and this is how you should do it as well. Okay? All right. Now, I'm going to give you a what if that will make this property even more powerful. Okay? What if I raise the rents $50 a month? Okay? So basically, I tell the tenants, hey, your rents are going up $50 from 1,200 to 1,250, right? And what tenant can take a $50 bump in their rents? That's expected because my insurance is going up, my taxes going up, my utilities going up, so I need to pass off some of those costs to them. I'm only raising rents by $50. Watch the impact, okay? So if I can raise the rents by $50, that equals $50 over 12 units over 1 year. That's $7,200 per year. And what if I reduce my expenses, right? I tighten down some things and I can save $5,000 a year on taxes, okay? So 7,200 plus 5,000 for the year. So I'm going to boost my NOI by $12,200 per year, okay? So this is going to increase my NOI by 12,200. So my new NOI is the 107,760 plus 12,200 equals 119,960. Follow me? Okay, so after I have raised the rents and cut down on some expenses, my new NOI after a year or so, let's say for example, is now 119,960. This is how you calculate what the new property value will be based upon my higher NOI. Here's the calculation here. I call it new value calculation. It's the new NOI divided by the same market cap rate. Okay, my new NOI of 119,960 divided by 6%, do the math, is $1,999,333. Let's call it 2 million. Okay. All right. So my new value is almost $2 million. I start off a year ago at 1,796,000, and after doing these two things over the next year or so, now is worth 1.9, almost $2 million. Okay, all it did was raise the rents and cut back some expenses. So now you can see how the NOI drives the property value. All right, so not only is my property worth $200,000 more, I have also increased my cash flow by this much too. So I get a double whammy, right? So now my property's worth $200,000 more, and now I'm making $1,000 more per month, okay? So that is the power of the NOI right then and there. All right, okay, hope you understood this. If not, go back and watch it again because this is so important. This is what we teach our students, and this is why they're successful. All right, let's go on to the last piece here. Ever wondered how pro investors find and analyze deals for maximum profit? How to secure financing even if you're a beginner? Or attract and keep tenants for steady passive income? Commercial Real Estate for Beginners delivers simple, actionable steps to master it all. Tap the link on the top corner for your free copy today. Here we are at the last part, and I want to I gave you the positive side. Now, as a responsible coach, I need to give you the negative side. Okay, so I talked about earlier how to get left behind in this business of multifamily investing. And how you do that is if you mismanage the property. Okay, as the NOI goes up, the cash flow goes up, the value goes up, but guess what? Conversely, as the NOI goes down, so does the cash flow, so does the property value. Okay, so understand that this is how NOI drives the property value up or down. Okay, so what if you mismanage the property? Okay, let me give you some real life examples. Okay, what if you have high vacancy? Okay, you have high vacancy because you have a bad property manager, or you're not taking care of the grounds, and your grass is uncut, and nobody wants to move in. Okay, what if you mismanage the expenses? Let's say the expenses go up because you took your eye off the ball and you let the property manager spend whatever they want to spend. Okay, or number three, let's say you're not raising rents because again, you took your eye off what the market say the rent should be, or maybe you got a bad property manager. Okay, or maybe your units are not in good condition and maybe you had to lower the rents. I don't know, right? But this is all three are three situations where you have mismanaged your property. So learn from that. You want to do the opposite of that. Okay, so what if this happens? Okay, so the rents would probably drop by $50 a month. Okay, just like our last example, over 12 units, that's about $7,200 a year. Okay, let's say the expenses went up $5,000 a year because, again, you took your eye off the ball, let the property manager spend what they want to spend, and now because of these two things, your new NOI now is lower. right? And it's lowered by 12,200, which is 7,200 plus the 5,000. So you're making this less money per year. So your NOI now drops down to 95,960. It was 107. Okay, now it's down to this number. So again, just like a few minutes ago, the new value calculation is the same whether your NOI goes up or down. The new value calculation is your new NOI divided by the market cap rate. So the new NOI of 95,560 divided by 6% market cap rate, your value had dropped to $1.592 million. Okay, the current value was $1,796,000, so it dropped nearly $200,000 because you mismanaged the property. You took your eye off the NOI. Okay, I hope that is a good lesson for you. That this year and next year and the year after that is a year of the NOI. Got it? All right. Okay. So everyone, I hope you enjoyed this video on the NOI. I know it's not an exciting topic, but now you can see how important it is. Okay. So if you want to learn how to evaluate properties well in a good way, commercial properties, multifamilies, I invite you to download my free book. The book link will appear. Go ahead and download it. All the evaluation examples are in there for different types of commercial property. Open it up, read it, and get out and learn. No obligation. It's yours for the taking. Got it? All right. Everyone, thank you so much for hanging out with me today. I appreciate you so much, and I'll see you at the next video. Would you like to work with me? Every successful commercial real estate investor has a mentor. Learn more about my Protege program right here.